Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories in corporate filings. Get ready for a financial deep dive that might just make you say wow. Today we're dissecting Cboe Global Markets' latest quarterly report, and let me tell you, it's a packed one. We're seeing significant jumps in revenue, but also some strategic shifts that are worth paying attention to. Think of it as a checkup on a major player in the financial market, and we're looking at how they're doing operationally and financially. Let's jump straight into the numbers, starting with their balance sheet as of June 30, 2025. Their total assets have grown significantly to over $9 billion, a jump from about $7.8 billion at the end of last year. What's driving this growth? Well, mostly their current assets are up a lot, especially cash and cash equivalents, which have increased by over $300 million, and also something called margin deposits clearing funds and interoperability funds, which more than doubled to $1.6 billion. This suggests either increased trading activity or perhaps more collateral being held for regulatory reasons. Their total liabilities have also gone up, mainly because of those margin deposits, but their equity has also seen a healthy increase, showing the company is growing and profitable. Now let's talk about how much money they're actually bringing in and keeping. Their total revenues for the first 6 months of 2025 really jumped by about 23% compared to the same time last year, reaching nearly $2.4 billion. This is a huge increase and shows that their core businesses, especially derivatives and cash markets, are performing exceptionally well. The cost of revenue also went up, but not as much as their revenue, which is a good sign. This means their actual profit before other expenses, known as revenues less cost of revenues, also increased by a solid 13%. And when we look at their operating income, it's up a massive 41% for the first 6 months compared to last year, hitting over $693 million. This is a really strong indicator that their main operations are not only growing, but becoming more profitable. The operating margin, which is basically how much profit they make for every dollar of revenue after covering direct costs, has improved significantly from 48.5% to over 60%. This improvement is despite some big expenses like the intangible asset impairments, which we'll talk about later. Looking at their expenses, compensation and benefits, which is their biggest cost, increased by about 5% for the first half of the year. This is likely due to hiring more people and maybe some bonus payouts reflecting the company's strong performance. They also saw a decrease in depreciation and amortization, which is good for profitability, partly because some older intangible assets are no longer being amortized. Now, here's where things get a little more technical, but are super important. They had a significant impairment of intangible assets, meaning they wrote down the value of some of their intangible assets because they're worth less than they thought. In 2024, this was over $81 million, mainly related to their digital asset business that they are winding down. In 2025, they recorded another $17 million impairment, this time related to their Japanese equities business due to increased competition. These are large one-time costs that can make profits look lower in a specific period, but often they reflect strategic decisions. Diving into their business segments, the options segment is still their powerhouse, making up almost half of their total revenues less cost of revenues. Revenues in this segment are up 19% for the quarter, driven by increased trading volumes, especially in multi-listed options, which saw a 22% jump in average daily volume. Their market share in options remains strong, though slightly down year over year. The North American equity segment is showing mixed signals. While their total revenues less cost of revenue stayed pretty flat, their net capture, which is basically the profit they make per share traded, dropped significantly by 53% for the quarter. This could be due to intense competition in this area. Despite this, they are the leading venue for ETP listings, which is a good sign for future growth. In Europe and Asia Pacific, revenues less cost of revenues are up a strong 30% for the quarter. This is largely thanks to increased trading in European equities and higher clearing volumes. However, their operating income in this segment actually dropped by 48% because of a big increase in operating expenses, mainly driven by those intangible asset impairments we mentioned. The futures segment saw a 14% decrease in revenues less cost of revenues, and their operating income dropped by 35%. This is partly because trading volumes were down, plus they've started including the results from their digital asset business in this segment, which is still in a transition phase. Global FX showed strong growth with revenues less cost of revenues up 19%, driven by increased trading volumes in institutional FX. Their operating income in this segment is also up significantly, showing good profitability. Now let's look at cash flow. Net cash provided by operating activities for the first 6 months of 2025 was about $1.2 billion. That's a decrease from the nearly 2.4 billion last year, but it's important to remember that the prior year likely had some unusual inflows. The decrease this year is largely due to less cash generated from changes in the margin deposits and clearing funds, which can fluctuate based on market activity. Investing activities used up about $136 million in the first half of 2025, mainly for buying financial investments and upgrading property and equipment. This is more than the $50 million used last year, suggesting they are investing more in their future growth. Financing activities used up around $218 million, which is less than the $346 million used last year. They paid out a lot in dividends and bought back some of their own stock, which are common ways companies return value to shareholders. Looking at their debt, it's pretty stable at around $1.4 billion, mostly made up of their senior notes, which have fixed interest rates. This means they aren't significantly exposed to rising interest rates on this debt. Plus, they have a $400 million revolving credit facility, which is basically an available line of credit that they weren't using as of June 2025, giving them financial flexibility. Cboe operates in a complex and competitive landscape, and this report highlights some key risks. One major concern is their reliance on third-party service providers. If these providers, like clearing organizations or data processors, experience issues, it could significantly disrupt Cboe's operations. They also mention the uncertainties surrounding regulatory actions and litigation, especially related to the Consolidated Audit Trail, or CAT, which could lead to additional costs and delays. There's also a significant challenge to new SEC rules on equity access fees. Cboe and other exchanges are fighting these rules because they believe the reduced fee caps could hurt their ability to attract liquidity and compete effectively. This legal battle could impact their future revenue streams. Another legal challenge involves a proposed rule about order and execution management systems, or OEMs. The SEC disapproved Cboe's proposal, and the company is challenging this decision in court. The outcome of these legal matters could influence their strategic operations and competitive positioning. So, what's the bottom line? Cboe is definitely a growing company with strong performance in its core derivatives and cash markets. Their revenue growth is impressive and they're managing their expenses well, leading to higher operating income. However, the challenges in North American equities, the recent impairment in their Japanese business, and the ongoing legal battles over regulations and fees are definitely things to watch. They seem to be making smart investments in growth, but the regulatory and competitive pressures are real. It's a company navigating a rapidly changing financial landscape, trying to balance innovation with stability. Alright, that's our breakdown of Cboe's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.